look back at what happened last month. It was an exceptionally strong month, right? So I guess what's happening now is just increased volatility because you kind of caught in a dilemma about whether growth is picking up, whether interest rates are going up faster in the U.S. The common themes that we started the year with, as in disinflation, energy prices going down, oil crashing, all that is reversing, right? So in this period where it's hard to play either growth or value. It's hard to play either monetary conditions easing or monetary conditions tightening. So I guess this volatility is likely to stay as we approach the time when the Fed ultimately hikes the interest rates.
Yeah, but the landscape was quite well defined though, and that is, the U.S. at the end of their rate cutting cycle and just looking for their opening, on when to actually make a nominal step toward normalization when so much of the rest of the world is in easing mode right now. I mean, Europe is just in the early stages of that. Japan continues with that. Is there going to be more? Don't know. China is now experimenting with different tools as well on easing. So the liquidity in markets is not in question.
No, our assessment is that some of the tightening which happens because the U.S. raises interest rates towards the end of this year is being compensated for by easier conditions in Japan, possibly Europe, and most importantly China as well. Therefore, our view on asset markets is that while volatility is likely to go up, we don't think asset markets are going to deliver negative returns this year.
Okay.
So monetary policy theme still stays intact for certain parts of the world.
Is there any sense? Do you get any sense that this volatility is not fundamentally is not being churned up fundamentally? That it might be large institutional money creating volatility, because there's nothing worse than a market that goes in one direction or just lies flat, right? I mean, you got to have a little fodder, a little bit of fuel for the volatility, volatility measured or volatility-driven funds out there.
Yes, and that is good because investors who are looking to enter the market gives them a chance to get back in. It allows a reshuffling of portfolios. And in this case, I guess the volatility is driven by changing perceptions, and U.S. yields have gone up to about 220 now. Euro area yields, look at German bonds, were down like to 6 basis points, now up to about 50 basis points. And of course, there are some concerns about Greece as well, right? The talks kind of look like getting through towards the end of last month, and then again, the last couple of days, the headlines haven't been particularly positive. So there is, I guess, some chips being taken off the table. Right.
The bond markets have been quite hot lately. There's been a lot of action going on in the credit spectrum. Do you think that is to stay, or is that one of these temporary sort of, rotational themes that pops up from time to time?
Well, we are underweight bonds because we think yields are going up. There could be short-term tactical opportunities.
A lot of bonds have done very well, right? Like Asian high yield has really performed.
Yeah, Asian high yield has done very well, and that's linked to the easing in China. The sudden surprise we got over the last 2 months. So therefore, our sense is again that it may not just be a beta play from here on. It's got to be more selective, more driven by an assessment of what each region is doing in terms of the fundamentals. So maybe low beta returns, but potential for high active returns going forward.
So what do you do now? I mean, if just to bring it right here to home, we've seen 4 down days, substantial down days. And just when we thought we might be on the cusp of 30,000, we're back to 27 or something like that. Do you take advantage? I could just see the writing on the wall, and some people saying, well, I like the story, and I like the the China reliquefaction theme, and the Shenzhen Connect at some point, and those are still there, on the calendar, and I like those themes. So at these prices, down, if I didn't think it was a bargain when it was down 2 days or 3 days, I'm definitely in the market now. But do you think we'll see that sort of a mindset take over?
Well, I think that investors who believe that monetary policy easing in China is here to stay will look to buy on dips for sure. Having said that, the momentum was too strong. It's flashing red on all our momentum screens, the price movement in China, especially offshore China in the last month. So I would not be surprised if this correction, which set in 2 days back or 3 days back, continues for the rest of this month. And at some stage, we probably see more easing efforts in China, maybe a rate cut. That's going to re-trigger the liquidity-driven rally.